Welcome to the live stream chat. I am going to go ahead and kick off the X stream as well. So give me a second to get that up and running. And we can chat. We can talk markets. My plan today is to discuss the business cycle, some recent tweets that have come out with regards to taxes and where I think we're at in the business cycle. I'm really starting to convince myself that we are probably getting into some of the later innings of the business cycle. And the business cycle usually ends via a big credit bubble, and that's kind of where I think we're at. So I really think that we're getting close to a bubble, which to qualify and make sure that you're not mishearing me, that doesn't mean that I'm bearish at this point in time. What that means is that new dynamics are at play. So I would call it a very bullish bubble type scenario. And bubbles are bullish. So we'll explain at least how I differentiate a bubble from a growth market. We'll get into all that. We're going to go through a lot of dynamics on that front. So let me make sure I'm running okay on Twitter. I don't see it at this point. So God only knows how that's actually supposed to operate. Adrian Terry, thanks for saying hi. Thanks for dropping by. Also, we had Adam in before the chat. Yeah, it's still showing on the screen. Thanks for popping in. Let's see. I know why it's not going on Twitter yet, because I gotta post it. I gotta post it. All right. I think we're good on Twitter now. And that's showing that we're live. Okay, so we're good there. Should be rolling on Twitter. Anyway, chat. If you're in chat, say hi. If you have any questions too, I'm absolutely willing to go as long as we want to chat. And then I'm absolutely willing to be derailed by questions. So feel free to ask a question. If you do have a question, obviously if you do like a super chat, I'll stop what I'm doing and engage with it. But if you do have a question, I'm happy to answer it. And then just put question in the question, and that will definitely it like highlights it in my chat. And that will, the word question lets me know that you have a question. Which asset class has been levered up to 11? I don't, wait, like can you buy an ETF that is 11x? I don't know. Or are you just asking which asset class has been way over levered? I mean, Bitcoin effectively operates like a 5x ETF. All righty. What do we want to talk about today? Brian, thanks for saying hi. Appreciate it. I think where we should begin is I want to discuss a little bit about this tweet. Let me move some screens here too. I want to discuss a little bit about this tweet right here with regard to what Buffo is saying with regards to tax receipts. And this has been kind of like an ongoing discussion within like those who know, the crowd that gets it, with regards to what we're seeing and some of the macro dynamics that are at play. When it comes to kind of markets, macro dynamics, and actually understanding how the macro cycle works, there's really only a handful of people that I trust that I think have even the slightest clue as to how to interpret markets. In fact, I can that are active, that are in the, I mean, obviously there's a lot of people out there, Warren Mosler being one of them, but he's less involved in kind of the day-to-day market stuff. But for me, it's Wabuffo. The next one's going to be George. Ben Kizenchuk has come on the scene and done a lot of good work as well. And then Mark Dow also has some pretty good ideas and thoughts and are worth following. And there are some others that are not quite as active. So if you're that person and I'm leaving you out, apologize. But those are kind of my biggies that I like to follow. And so within that, there's been at least within Bill and George, kind of a bit of a split with regards to what tax receipts are trying to show. And I kind of brought in a third way, if you will, that I think kind of explains things nicely. So that's really what I want to talk about. And the reason that tax receipts matter in the first place is tax receipts are a consequence of business activity. right? And that's like the best way to think. I saw this take by Samantha DeLuca or somebody like that. I mean, just an absolute dumb take that, they're not there's no predictive power or anything with regard to tax receipts. Tax receipts like give you so much information. Like they are, it is a great, it's the spending, the outflows, the outlays with regards to the daily treasury statement, obviously probably the most important data you can follow whatsoever. But on the opposite side, the receipts, the tax receipts are so impactful. They're so important because they really give you an insight into business activity. And the more people you're hiring, the more the private sector is hiring, the more taxes ultimately have to get paid. And as taxes accelerate, that means business activity is also accelerating. So they're a very good leading indicator. So it's worth following, and particularly when you then tie those into the broader macroeconomic cycle, the macroeconomic kind of framework that we've built up, they mean even more. And that's what we'll do in just a second, is kind of build that out and tell you why what I'm seeing in taxes is different than what everyone else is seeing in taxes. I'm not as bearish as George seems to be right now. And I could be, if George or Bill, if I'm misinterpreting your arguments and you happen to be watching this, DM me, and by all means we can set up like an X chat or whatever, and we can jump on and chit chat. But with regards to where I think we're at least what I think taxes are showing, and there's a broader kind of discussion to be had here as well. I think what I'm seeing is the beginning stages of a bubble, and that's really kind of potentially a bubble. And again, you'll understand why I'm qualifying that in just a second. But what taxes show us is they show us business activity, and in particular, and I did this, or I showed this. Let me just open up a new tab here when I retweeted my thoughts on this, and that is this tweet right here, that there's this like third way to understand what taxes are doing. And one of the things you'll see is a very strong correlation between taxes and credit creation, right? So there are two ways effectively, there are two ways to create money in a monetary type system like we have, fiat monetary system. One way is exogenously, and that is just the government spends. And the net effect of that, when you break it down in a sectoral sort of analysis, sectoral balance sort of analysis, is that when the government spends, that's a net financial add to the private sector, right? So the government sector takes on the debt of it, the private sector takes on the asset surplus side of it. But that's not the only money creating engine. That's the exogenous engine, but there's also an endogenous engine, and that is the credit cycle itself, right? And so the credit cycle, if I were to run a business and I wanted to create some new production, and I think that I can increase my profits because of it, this is capitalism 101. What ends up happening is the creation of that loan itself creates new money. Okay, but the difference is when the government spends, the debt stays out of the private sector. But when the private sector itself leverages up, the debt stays within the private sector. And that is the key difference. And that is why, too, we distinguish them between exogenous and endogenous. Endogenous because it's the system itself creating the demand for the money. There's no policy decision that says, well, up until recently, there's no policy decision. I say with a bit of a wink here. There's no policy decision that says, oh, you're going to take out this loan, right? It's because the private sector thinks that they can create profits. And that's like post-Keynesianism 101, right? That the reason loans get created is because the person taking the loan out thinks they can make a profit on it. When we're talking, it's an important qualifier here, when we're talking about like macroeconomic growth, right? You can also take out a loan and have money creation if you want to speculate, right? If you think that you want to buy some sort of asset like a house or something like that because you think it's going to appreciate in value, right? So there's that aspect to it too. So that's kind of the landscape for now. We're gonna loop back to that discussion in a little bit more detail in a second, but just to give context for this overall discussion with regards to taxes, that's kind of where we're at, right? And Bill's point that he made in his tweet was that, hey, taxes year over year are still increasing, right? Which is true. We're still increasing the rate at which taxes are being received. And as he pointed out in his tweet, this is what data looks like when you're heading into a recession. You get a decrease in growth of taxes. And he is absolutely right that when you start to get layoffs and you start to get contraction of the labor force, that taxes are going to dip negative in terms of rate of change, year-over-year rate of change, because that's just the consequence of layoffs, right? The private sector is paying less taxes. And so he's pointing this out, and that more recently, and I'm trying to see if he's got anything in here of what he's showing, but he's at like 10% year-over-year growth or something like that. And my point is, and where I kind of came in, and his point was a counterpoint to George, is, I can't understand his charts sometime, but George's point is he doesn't like what tax data is doing, right? And then I come in and say, yeah, I actually think I'm like 50% in agreement with Bill. We're still at a growing tax rate. But what I like to look at more than just the rate of change is, let's go to the second derivative then. Let's go to the actual acceleration. And that is what I have on the chart here. Now, how I derived this chart on top is I actually got tax receipts going all the way back to the beginning, and have since accumulated them over time. And so then I calculate the velocity and then the rate of change of the velocity to get the acceleration that you have, and add a 30-day moving average to smooth it out. So that's what that is. And I think it tells a little bit better story, or gives you maybe even a little bit more information about like the underlying dynamics that are causing it, right? And so what I'm seeing right now is I'm seeing tax receipts still growing year over year, but that growth rate is decelerating. And it's decelerating as credit is accelerating. In other words, and there could be a lot of explanations as to why this is. It doesn't necessarily have to be the explanation I'm going to give. And I could be wrong about it, but there are other things that make me think that this is actually maybe what is happening. But what concerns me when I see a divergence between credit accelerating and taxes decelerating is that credit is likely going to less productive means, right? In other words, it's not going to the sort of economic growth where I'm going to hire some employees to work a factory to create more output. Those employees now have wages. They can buy the crap that we're making at a macro level. What concerns me is that it's going to, AI data centers. And yeah, we might get some big production boom from all of this, over the next 5 years, but immediately that new investment isn't going to employees, right? It's not going directly, the pass through, there's going to be a lag to the pass through to whatever benefit we're going to see. And the immediate jump is not directly to employees. So that is kind of the concern, is that it's more just kind of bidding up asset prices at this point in time. So that is my main concern. And in and of itself, this is just one kind of piece of evidence that we would need to see for a bubble per se, right? But it is definitely the first line of evidence. Some of the other arguments as to why taxes are doing this is there's just a delay in some of the tax receipts from California because of some recent natural disasters that happened out there, and that could also be explaining it. But given the job numbers that we saw, I think that's a fairly reasonable explanation. The other insight to this too that's going to be important to think through is this is also probably a part of the broader supply shock that is kind of ongoing right now because of the tariff thing, right? And to kind of think that through, just a little bit in just a little bit more detail, when supply shocks happen, and we saw this during COVID. In fact, you can even see it on the screen right here. You saw a massive, I don't know if you guys can see my mouse. Yeah, you saw a massive jump in loans right as COVID hit. And this happens in a supply shock scenario because you have to draw on credit out of uncertainty. And I think what is happening is we're seeing that same scenario play out, and that too can breed its own business cycle, right? So what's interesting about credit acceleration is, even if it's in a scenario like we're potentially seeing right now, where incomes are drawing down for like the productive cycle and they still want to pay their employees, and so they're going to increase the overall credit demand, this has a feedback loop situation where the very loans that are getting created are creating the money that are now going to fuel the very expansion that they need to sustain, right? So this very supply shock is now creating the demand that needs to now fill in the void of the supply shock that will support us on the back end of the immediacy of the supply shock, right? And so there is that other dynamic here where even though it's a supply shock and even though we're literally shooting ourselves in the foot, Plaxico Burress, if you're an OG Michigan State fan like myself, you remember that we've Plaxico Burressed our economy here. In an almost ironic way, it's actually going to now give us this, kind of end of the cycle boost, probably into 2026. So with that in mind, I think we've hit the big things. I think I've mentioned the supply shock. I've mentioned why this divergence matters, why it could be showing that we're moving more speculative. The broader business cycle, endogenous, exogenous money. I think we can move on to understanding this in context of the business cycle. Before we do that, though, let me hit up some. I did get a super chat. Awesome, Ty. Thank you very much. 10 Canadian dollars, which is now more than it has ever been in the super chats. Employee bonus to my boss. Appreciate it, Ty. The dollar is not doing well. Let's look at some other chat. Let's see. I'm going to scroll on up here. Where do you see this bubble originating? We will talk. I mean, it's what I'm going to explain. In why it's almost inevitable that every market enters a bubble phase, right? But really, the question is, what does the fiscal cycle look like, and how bad can the bubble get, right? It's really that's really what's going to play out. What happened to the rest of the AppliedMMT gang? They'll be back on. I can bring them back on. This is Ty was streaming. I didn't even know Ty was streaming today, but he was streaming as I wanted to go live, and I just happened to have time. So I hit live and ran for it. When rates fall, it makes payments easier. Fiscal falls, but doesn't all previous issued higher yielding bonds increase in value as well? Wouldn't that increase holders' creditworthiness? Yeah, I think there will be. This is a good question. So I think there will be a positive feedback loop if rates were to drop. They likely will. Now at this point, I haven't paid too much attention to the dot or to the forecast plot for the Fed. Maybe I'll check that out on stream. But my guess is there's probably a likely higher hood now, or a higher likelihood now that we're going to get a tax or a rate cut. And yeah, the immediate feedback loop would be just lower costs to the private sector. And I think that could spur on kind of the credit bubble. But the other side to that is lower income as well for the private sector. And so again, and actually it's probably worth hanging out on this point for a minute. It's that piece right there that also makes me think that we're headed to a bubble, right? And this is why you will always see rates fall into a collapse, in part because the credit cycle is starting to kind of wane, which gives the initial signal to the Fed that they should cut, think that they're going to boost, growth. And then that then takes away from like the last remaining support system of the business cycle at that current time, which would be the fiscal side, and then you just get a complete collapse because that helps that last bit of acceleration in the credit cycle kind of amp up even more, and then eventually kind of get this collapse. So, yeah, I do think I do think that's a fair way of kind of seeing where rates are at right now. Oh yeah, I didn't even see the next part. Yeah, could that extend? Exactly. Yep. So it would help on the short run. I do agree. I absolutely agree with that. Bubbles originate from credit expansion. Absolutely. Dr. Sadler, that is the bubble cycle. Explaining the tax data, past tax cuts kicking in. Don't know U.S. legalese, but headline figure are cuts to the tune of $5.5 trillion, if I recall. Yeah. So I think what you're getting at is like maybe what the CBO estimation is for what the tax cuts are going to do to the ultimate deficit relative to spending. And I think I've mentioned this in prior videos, but the long and the short of it is, if you look at like the CBO error in terms of how far they are off in their own forecast, where they're off is just with the business cycle itself. They just don't understand the credit cycle. And so their forecasts are well, I mean, they're off by the business cycle. I mean, that's where they end up being off by. And so I think that what will likely end up happening is, currently it's, I forget how many trillion over the next 10 years, but whatever it is, I think they're going to way undershoot, actually, ironically, what tax receipts are going to be over that amount of time, and overshoot what it is they're ultimately going to spend on net for the deficit. And so I'm a little less convinced that anything that we're seeing in the tax bill immediately is going to have some huge boost to offset what I will kind of see as kind of the kind of brewing bubble that we're seeing. Yeah, Dr. Sadler, absolutely. Fiscal looks identical. And that is the problem, is that fiscal looks identical and it's not changing, and we're not seeing that change. And that is kind of the other concerning part. Confused with the time outlook of uncertainty, you get more loans. Explain on that, Adrian, and maybe I can linger on that point. I'm not exactly sure what you're asking. Okay, moving on to kind of the next big point here in terms of the business cycle. So buckle up here. I'm probably going to hide chat for a second. We're just gonna talk. We're gonna riff here. Also, before we do, if you're watching this on X and you want to interact, jump over to YouTube. I don't think I'm keeping the X broadcast up on the side screen. So if you have any questions, bring them over to YouTube, and I will answer them there. All right, so we're gonna go all the way back. we're gonna start kind of at the beginning here and think through the business cycle. And I've got this little sinusoidal wave function here on the screen. And what I just need you to envision is that there are two predominant money creation cycles that are taking place at any time. There's the fiscal cycle. We talked about this at the outset of the stream. There's the fiscal cycle. This is exogenous money. And then there's the credit cycle. This is endogenous money. And so the fiscal cycle is, I think my head's in the way here. We got the business cycle here. So the fiscal cycle is what the government's spending, right? And it's cyclical. It has ebbs and flows over time, in part because there is a feedback loop, and that's going to be tax receipts, right? So there's kind of a cyclicality to it. And the feedback loop is tax receipts, and then the other feedback loop is when you get a recession, you get the automatic stabilizers, right? And so that's what makes the fiscal cycle from kind of accelerating to decelerating. You then have the credit cycle, and the credit cycle is also creating money, and loans create deposits, that creates new money for the economy. And so from a credit cycle standpoint, that two cycles. Now, that cycle is quite a bit different in terms of the feedback loops. The main feedback loop is what is profit expectation and what is the actual profit realization, right? And so the money creation cycle for loans is going to be, well, if I'm making more profits, so I being the royal I for the private sector, if I am making more money, then I'm going to get more loans. And there's this feedback loop where more loans creates more money, which creates more profits, which creates more loans, expansion, and that sort of thing. And eventually, and this is like the Goodwin Growth Model 101, it's a predator-prey model. Eventually what ends up happening is you also get the ask from the workers, right? So the workers are asking for more money as well. And you get this kind of inflationary push that happens at the same time where the workers ask for more money, the labor pool thins, and so you end up having to pay, the businesses have to pay as unemployment gets low enough, they have to pay for the higher wages. And you end up with the wages starting to eat into the profit share, right? And so it's going to be the main headwind to that growth cycle is profits end up being eaten up by higher wages, and then that at the global aggregate macro level starts to depress the credit cycle. And since the feedback loop is as the credit cycle is pushing higher, so you can envision the credit cycle in, actually I should be hovering over, hopefully you can see. Yeah, so let's do this. As you get to the apex of the credit cycle, change my color here, as you get to the apex of the credit cycle is also producing tax receipts that are being paid to the government. And so the government cycle, the fiscal cycle, is going to be at its lowest point, right? So there's that feedback loop. And things like unemployment are going to be at their lowest, right? Because everyone's going to be employed. And so there's a counter feedback loop, and that's when you end up getting this massive gap in between fiscal and credit, okay? And it's when you get to this point where fiscal is going to peak, you get to the apex and start to decelerate, and this is kind of what Steve Keen's brilliant insights are, is that you can still have credit you can still have credit growing year over year, right? So the first derivative credit is still, the velocity is still rising in credit. But if it even starts to decelerate with a sufficiently large enough private debt load to GDP, even the decelerations, in other words, even if you make, even if there's $1 trillion of loans one year and there's 1.1 trillion the next year, you can still have it be this acceleration of that sufficiently low enough where even though it's still growing, you actually don't get enough additional add for aggregate growth to then see a slowdown in the economy, and that undermines profits, and then profits undermine loan creation, and then you get a collapse. And this is what happened in 2000 and happened in 2008. We saw kind of a mini version of it happen in 2022. My guess is the next cycle ends in 2026. We'll see this. But that is the ebb and flow. That's how the business cycle works, and that's kind of business cycle 101, right? And that's why we see how the cycles play out. And so the question always is like, where the heck are we in this cycle, right? And my argument, and the thing that I'm starting to see is I'm really starting to see from the fiscal side that fiscal is not as aggressively adding to aggregate demand, aggressively adding to growth, aggressively adding to profits as it was at the end of, say, 2022, 23 through 24, maybe even in the start of the year, right? I think what we're starting to see is a deceleration of fiscal. So first, first what we're going to need is we actually will need fiscal to fully collapse, right? That does have to happen. We're not there yet. But in order to get velocity of fiscal to lower, we first need deceleration. And that is my argument as to what we're seeing, right? So in other words, we're in the early innings of a bubble. And in the grand scheme of things, it doesn't change too much. We'll still probably see stock market booms and that sort of thing. But certainly from like a sectoral standpoint, right? Like what sectors are going to do best in the macroeconomy, that will shift. But immediately it doesn't look like all that much. But what you do see, one of the kind of symptoms is fiscal starts to drive lower, push lower, is you do see a strong acceleration in credit to make up for it, right? I just realized I am drawing the wrong line. Fiscal is blue, credit is red. So as what we'll go over here is fiscal starts to drop, credit starts to rise aggressively, to where there's not enough public deficit spending to offset the savings desires of the private side. And so now the private side wants to go ahead and leverage up to increase its savings. So that is kind of what I think we're seeing. Argument number one for that, and this is all going to tie back to the tax receipts. So we'll get there. This will all tie back. But if we go to AppliedMMT.com, and we take a look at the data dashboard and we look at the monthly treasury statement, and then we're going to do Trump spending comp here. What you end up seeing is because of the tariffs, we are at effectively identical spending to where we were at last year. Okay, now, this is the tricky part, is that identical spending still means we're spending a lot, right? But we're not accelerating in spending. And in order for growth to grow, you have to have accelerating spending. You have to have more than the prior year, right? You just can't be growing. You have to grow faster. So we're not getting any growth out of fiscal. We're getting probably enough to sustain, but not enough to grow. And when you look at it then in kind of a first order or first derivative standpoint, it looks like, oh yeah, we've got a lot of fiscal, right? So here's that. I like to look at this monthly treasury statement view because it does just show the bigger picture. And in and of itself, we are. I'm not saying that like today the bubble is popping. My argument is we're starting to see the deceleration occur. And that is where the bubble actually begins in my definition of the bubble. My definition of a bubble is when growth is solely dependent on the credit cycle. And at this point, I think that's where we're at. We might not be there entirely, right? I mean, it's impossible to add up. Well, almost impossible. We're building a tool that actually will do this, but it is very difficult to add up every dime and understand where every bit of aggregate demand is coming from in the macroeconomy. And I don't care to do that per se. It is not necessary to get that, but I think we are close enough to the potential of a bubble that I think I'm ready to say that we're in that bubble economy. And I also think too, to like add to the evidence of my argument, it would be that really smart people that have been right in this prior cycle are now disagreeing about this exact thing, right? Like we're seeing smart people who track data, who understand what they're doing, have different views. And I think it's exactly what I would expect as kind of a bubble that's emerging, right? And so we're seeing this slowdown, and eventually where we will get. And now I look at deficit spending itself in real terms because I think it's a little bit more important, a little bit better measure of kind of the efficacy of what fiscal is doing. But when I look at like say 2008, right? This is where we don't want to get, right? We don't want to get to essentially in real terms surpluses. Exactly the same thing happened in the late 90s. Now, of course, we had a credit bubble drag on for a very long time in that space. But again, that's where we don't want to get. We saw it in the 70s, late 70s and into the early 80s. Same idea, right? 2022. But the whole point is we first decelerate and then we go negative, right? And then we actually start in a surplus. So I think we're starting to decelerate. And so that means going back to this whole concept that the endogenous cycle is starting to take off, right? And you can see that, I mean, in that tweet that I had, right? We're seeing loans and leases really start to accelerate almost at 5% a year. And you have to realize private debt is, I mean, the total private debt load, I think, is like 50 trillion or something like that. So I mean, 50 trillion at 5% a year, that's a lot of new money being created, right? And when that thing finally reverses course, which it inevitably almost has to do, that's going to be a massive drag as well, right? And so I would say we are like right at that inflection point where, you know, what we're seeing as GDP is predominantly, if not fully, being accounted for because of the endogenous side of the cycle. So I hope that clicks for now. And I think that's probably a good spot to go ahead and stop here for just a second. I'm going to now just kind of pull up the questions and kind of see where we're going at this point. If there's anything that I haven't hit yet, let me know that would help add to this. Let's see. Are you tracking the credit cycle, second derivative, Doug? I'm just doing rate of change at this point in time. On the website, I do have the I guess I should highlight this question. I do have margin debt acceleration, which actually margin debt acceleration, I can just pull this up. And if you guys are watching and you are active traders, active investors, by all means, head on over to AppliedMMT. You get access to all this data and watch this in real time. But I pay very close attention. Well, we haven't had a big bubble burst in a while, but I think you should be paying very close attention to the acceleration when it comes down to margin debt, because that will likely tell you kind of where we need to be or where we're at when we finally get to like the point that you want to sell. And you can see that margin debt acceleration peaked in mid 2021 and then finally went negative as we got to the end of 2021. And so, I mean, that was the clue that things might be getting dicey. And then if you look at the first derivative, so just percent change or velocity, we finally went negative in February of 2022. And if you were an AppliedMMT member back then, you remember me saying, I think probably around April-ish. I think it was my target March, April. And of course, we had the war and the invasion of Ukraine by Russia take place right at that point that kind of jump-started the bearish market. But if you recall, I mean, that was kind of our window that we thought things would get very bearish. So what I'm looking for now is, acceleration. When the acceleration peaks happens, and then when that acceleration peak starts to die down, so acceleration will have to get negative first. That's kind of the first warning shot. And then when first derivative hits negative, that's definitely probably right at the point where we're starting to see a lot of kind of negative flows. The other thing we'll want to see too is just a very strong spike once again in margin debt as well. Just the acceleration and the rate of change as well. That'll give us a good hint that we really are in kind of a bubble mania, bubble phase sort of thing. So yeah, good question there on that front. So I think we've built the foundation now in terms of understanding the ebb and flow of the business cycle, the kind of various feedback loops with regards to fiscal, with regards to endogenous credit. And yeah, Thomas, welcome. And by the way, yeah, thanks, man. 6 likes. Yeah, I agree. We can get some more likes in there. I appreciate it. So let's do this. Now that we have this idea that fiscal is dominant at this point, and you might not be convinced. I'm sorry, not fiscal. Credit is dominant, and you might not be convinced. Let's do this. Let's zoom on into this idea of the actual Minsky cycle itself. So what we're doing now is like the first layer that you have to understand is you have to understand the cycle from the fiscal and credit cycle, right? So fiscal creates the first profits that then spur on the credit cycle. The credit cycle itself creates this negative feedback loop, which slows down the fiscal cycle. And eventually the fiscal cycle ceases to accelerate year over year. And so the growth is now solely dependent on the credit cycle. So the first question you got to ask, and this is just, you make up your own mind here. Have I convinced you that, are you convinced that the fiscal cycle is slowing down? I don't even know if I am, right? I mean, I'm ultimately going to, pass my final judgment on that probably as we head into 2026, because the one big beautiful bill, fiscal year 2026 will kick off, and we'll start to see some of the impact of that, right? So things very much could change up to that point, right? My opinion could very much change when we see fiscal into 2026, and it could completely, fiscal could be enough to support a continued credit cycle, just like effectively it did throughout all the 2010s, right? I mean, we could, we never got a boom for various reasons that I've explained in the past, and fiscal was always sufficient enough throughout the 2010s. So we could revert back to that scenario. But if you're convinced at this point that we're seeing waning fiscal, and the next question you got to ask yourself, okay, is where are we at then in the credit cycle? And the best way to understand the credit cycle is through Minsky, right? The instability hypothesis. And the instability hypothesis is this: is that as the credit cycle begins, you start this like people are freaked out, right? When the credit cycle begins, people are freaked out. Think 2009, 2010, credit cycle starting back up again. Like no one's going to invest in crazy endeavors that are likely to pan out, right? You don't get speculative stuff at the beginning of a cycle. You only are going to create a loan if you're a bank, if it's the most sure thing. So the credit cycle kicks off, and Minsky called this hedge finance. So this starts the cycle, and it becomes successful, right? So the toothpaste company creates a new toothpaste factory, right? Everyone's got to brush their teeth. We get expansion, and then it's successful, right? So Colgate, they make a few more profits on the toothpaste, and so you get these these really low risk sort of loans go out. And the bank ends up making a little money off of this, and everyone ends up making a little bit of profit. They make a little profit, remember, just keep this in the back of your mind, because the automatic stabilizers that kicked in. This is going to be really important, right? I mean, what did the one big beautiful bill do? I'm sorry, I'm going to go off on a tangent here. It really messed up the automatic stabilizers, right? This is going to be tricky, very, very tricky if we do go into a recession, what happens out, because a lot of those automatic stabilizers, they're going to be undercut a little bit. But anyway, go back to this. You get the automatic stabilizers. And what the automatic stabilizers do is they produce that first profit that allow the initial kind of hedge financing, the most least risky loans to be successful. And then banks are like, wow, that worked. I should climb up the Minsky cycle. I should start doing a little bit more speculative financing, right? Maybe I throw some loans out there. I do some business activity out there for things like AI investment, right? I don't know if it's going to work out. Probably only one or two companies are going to win, but if I get right and I pick the Amazon, or I pick the Microsoft of AI, I'm going to be a billionaire, and this is great. Or, we're going to have these great returns, right? That sort of thing, right? Maybe I'm willing to do, loosen up on things like, really speculative stuff. Well, I'll get to that in a minute, but maybe, mortgages to lower income people or something like that maybe can't quite afford it. So I'm going to go, I'm going to go a little more speculative. And the very fact that the first loan creation was successful in part because of this massive fiscal help for the profits, and because the very loans themselves create the necessary income to create the profit, you get this continued successful trend, and the speculative works, right? And they go up in price. And it's like, oh my gosh, yeah, this is working. We need to continue to create new loans. And that is where you get into more, and there's a bit of psychology here as well, but this is where you start to get into more what's called the Ponzi finance. And at this point, this is where loans start getting created solely based on kind of asset speculation, right? And without a doubt, like things that are happening in the Bitcoin world are exactly this, right? It is pure money creation for the sake of asset price inflation, right? And you get to this point where not only is this like a tenable strategy and a palatable strategy, but it becomes a necessary strategy. And there's two kind of forks in this road with regard to this concept. The first is that the assets themselves, I mean, if you think about it, a bank's balance sheet, like their asset prices can't fall. And just like in the great financial crisis, banks had all these completely worthless loans on their balance sheet, right, from the mortgages. Envision today, banks are going to be tied, or some of their assets are going to be tied to the value of Bitcoin now, right? And so, whether it's not directly, I mean, I don't think banks are allowed to hold, Bitcoin as an asset directly. Maybe I'm wrong on that. But either way, the money is finding its way that's being created into this Bitcoin world. And so now you're seeing a lot of the overall asset valuation directly pegged to something like Bitcoin. Well, Bitcoin has to go up, right? If there is any connection downstream where the value of the assets on the financial sector book is anyway directly tied to the value of its assets, and those assets are purely speculative assets, they will drop. And they will drop, and that will cause a cascading event that kills the rest of the assets on the bank's balance sheet. And that's how recessions happen, right? And then this entire thing reverses. Everything that we talked about at the outset reverses, right? You get layoffs, right? So now you're not spending money on labor anymore, and that money that you're spending on labor isn't buying the goods and services, right? So the demand drops, and you get the cascading, collapse of an economy that we've seen play out in recessions. And so, with that in mind, there's the Minsky cycle, right? So if you go back to, the argument that I'm making, and you're convinced that, hey, fiscal might be slowing, maybe it's still too early to tell, but it's certainly not the way that it was in 2023, 2024. Certainly, we're years away now, what seems like decades away from the spending that we saw at COVID. And the question is, where are we at in this cycle, right? And where are we at in the cycle also relative to where fiscal is at? And my argument is that we're probably getting closer, going all the way back to the start of this live stream, we're probably getting closer to Ponzi type finance than I think most people realize. And in part, again, I'm not paying a ton of attention to the Bitcoin stuff. And if you are a Bitcoiner, by all means, like everything I'm saying is the stuff you want to know, right? Like I will be able to tell you when the bubble will pop. And I will tell you that when it does burst, it's going to be bad, right? It's going to be bad because we have seen an incredible amount of credit creation that supports Bitcoin over the last say 10 years, and it's going to hurt when we finally see the big one, right? And it could end up killing the industry altogether, depending on how policy and everything ends up playing out. I don't know if it will. I haven't yet really seen any real utility yet at this point for Bitcoin, and so I don't see. It's kind of interesting. I probably shouldn't say this on stream where it can be recorded, but I actually did buy, not Bitcoin itself, but I bought into crypto very early relative to most people, not because I thought it was going to be some great investment, but I play poker. I'll spit it out there. I play poker, and before 2019, the only place you could really play poker online for me in Michigan, I can now play it legally online on regulated sites, but before you couldn't, so you had to deposit Bitcoin. And so I had Litecoin and Ethereum because those went the quickest on the exchanges that I used for the poker sites that I used. And that's how I end up owning it. Other than that, I can't think of like an actual meaningful use of Bitcoin when it comes to like any economic endeavor, right? So I would absolutely continue to put Bitcoin in that kind of Ponzi finance space. But in the meantime, like the asset, I mean, here's the thing too, just because we're in a bubble, the whole point of a bubble is the asset has to go higher during a bubble, right? In other words, we'll know we're absolutely in the bubble when Bitcoin is starting to accelerate at its fastest, right? So I haven't really looked at the price, but recently, but we really see, and I think we actually have been seeing quite the surge as of late. But that's really when we're going to know that we're there, because it has to push higher. Otherwise, crap will hit the fan. So sorry about that sidebar there on Bitcoin. But suffice to say, at some point, the overall asset valuation of the business sector or the financial sector will collapse, and then that creates the downward spiral into the recession. So going back, let me get a little sip of water here. Going back to the outset, why I think we're in a bubble is, I think at this point, I would just define a bubble as a business cycle where growth is, at this point, fully determinate on credit. And I think we're almost there. Now, that absolutely can change because the fiscal side is exogenous. It is not endogenous, right? It's not up to the feedback loops necessarily of the business cycle to push the cycle. It could change, and all it would take is a stroke of the pen by Congress and Trump, and we're on a different path. But as it stands right now, I think we're at that apex point where, or I should say maybe more inflection point, where fiscal and endogenous are both at their peaks and troughs, and that's going to end up going in a different direction. And really, in reality, to probably make this a little bit clearer, let me do this. Let me just kind of move. Let's do this. Let's move this down here. I'll get to this little diagram below in just a second. But in reality, the cycles probably look a little bit more like this. So what did I say? Fiscal was blue. So fiscal probably leads the business cycle a little bit more like this, right? This is probably a bit more how it actually plays out. In reality, it's like a 6 month to a year, or if you have just a major boom cycle, maybe 2 years, like we saw in the late '90s, where something like that ends up playing out. So the exact sinusoidal chart is probably not the best example. Or probably not the most precise visual. So what does this mean then? Well, if we plot this then in a phase plot, right, which is now effectively, I think this is the thumbnail as well. Get to the thumbnail part. If we plot this in a phase plot, this is effectively what I'm saying is at some point you eventually get into, I would say we've been in the growth zone for the past. I don't know, 3 years, but we'll call it post 2022, right? We've been in the growth zone. 2022, the end of 2022 really was kind of a surprise to the upside. That also was like 2010, 2011. But now what I'm saying would be like another example of it. 2016 would be another really good example. I think we had like a shadow recession in 2016. Kind of like I would say what 2022 I'd call a shadow recession as well. But now what I'm saying is, I think we are like, I'll put this in white. I think we are right here, right? We are absolutely on that edge. And I'll tell some other kind of compounding ideas with this that might compound this fiscal idea as well. But the point is that the credit cycles, right? I mean, it does go boom, 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 but the fiscal doesn't have to cycle, right? Even in rising fiscal, you still get a credit cycle that plays out. It's just sometimes the effects of the credit cycle are so low, 2015, 2016, 2022, because the fiscal is so strong that it just doesn't show up as like a massive recession. And I think we're right here. And again, I'll tell you some other issues that I'm having just with the macroeconomy as a whole. But once we drop below on the fiscal cycle and we become solely dependent on rising credit, to me, that is definitionally a bubble. Just what I would call a bubble. Does a bubble have to pop and get us into crap hitting the fan zone? Not necessarily. It very well could. That's why we need to be very vigilant about what fiscal looks like once the fiscal year 26 starts up, to see maybe we could get back into the growth zone. But yeah, I think we're in the bubble zone. So a couple other things that, well, let me do this. Actually, before I go there, that's my point, right? So why I think we're in a bubble. But before I jump forward, because what I'm going to do next is I'm going to discuss, and kind of the final thing, if there are no other questions, I'm going to discuss some other things that are just worrisome. I've talked about it in other videos. It has to do with the dollar falling, and that'll kind of be the last point. It'll be quick. But let's see. Jonathan Newman, worried about rising credit card, auto loan, student loan, delinquencies, falling house. Yeah. I mean, eventually this stuff will all start to compound in and of itself. And this is like the other thing too, is I know a lot of people like to get into micro details in terms of like what different layers of credit are doing. I just, in all the modeling we've done with Deep Minsky, I haven't seen any reason to believe that the various kind of striations of credit matter to the broader macro picture. Like, it matters for who's going to get hurt and how bad it's going to be. But that's a micro question. That's not necessarily a macro question. So even if we're seeing things like delinquencies and various sectors of credit doing worse than others, it doesn't, I'm more concerned from a macro perspective just about how much money is being created. I mean, I guess you could say I'm cold-hearted in that aspect, because I do realize, I mean, I think actually this is probably a good point to mention. I'll talk politics for just a second here. This to me is like just the devastating aspect of the one big beautiful bill, is from what I can tell, where it's definitely, it's offsetting the tax cuts by spending that we would normally call automatic stabilizers. And that is like the big concern to me, is that when inevitably we get the next business cycle end, is that the automatic stabilizers just are not going to kick in as strong as they normally do. And that could create a very slow recovery. So when it comes to the individual lines of credit, no, because it really is just, what is the top line number, how much new money is being created, and that's going to either propel or slow down the business cycle. But yeah, good question. I probably should care more. Look into it more. Does increased venture capital investing elongate the credit cycle, or is it too small a portion to make up the difference? Another good question. Okay. Venture capitalism or venture capitalist type investing is not money creation, right? It is just money transferring, right? It is truly like what kind of like hard money types think of banking, right? Like, there's no money creation that's happening there. But what we're finding out, and actually Ben Kizimchuk has a lot of good stuff on this. Check him out. He's got a lot of good stuff on this, where it's very clear what's happening. And I think he responded to a thread of mine right here. It's very clear what's happening is right now banks, and I think it's this other loans and leases is the point he's making in this right here. Banks are extending credit into, what you would call kind of venture capitalist arm that is, oh, you guys can't see this. Sorry. Banks are extending credit through venture capitalist arm to do things like this, right? And so that is how the money creation is happening through venture capitalists, is taking just kind of two steps. So directly, if I had $1 million that I had for like a venture capitalist, I'm gonna buy up some defunct Ruby Tuesdays, I don't know, and do something like that, right? Like, there's no money creation happening there directly in that instance, right? It would have to be a bank creating the loan deposit pair to actually do that. So how how that's being accounted for now is what Ben is talking about there. But directly the step of venture capitalism in and of itself is not actually extending the cycle or not. But indirectly it is, because in reality, banks are just finding a way to loan out to these types of firms who are then doing this, which actually is interesting, because that I would just consider that to be a highly speculative type of investing, right? I mean, you're generally buying Payless shoes or something like that, right? And trying to flip that, so that'd be a little bit more speculative. So there's kind of that aspect of it. So yeah, really good question. Really good question. Let's pull up the questions again. Doug, you still haven't told us what you see being inflated: real estate space for data centers, materials, graphics cards being scalped. What will be inflated? And I don't. Maybe your question is, what is the credit actually being used for that's being created? And this is where I'm just going to say, I don't know. And from a macro perspective, I do care, but from a macro perspective, I don't care, in the sense that, like, it doesn't matter what it's going to, for the cycle standpoint, just that it's going to something. The AI data centers is very convincing. That makes a lot of sense. I mean, that would also very much explain why hiring is down while credit is just booming, right? You don't need to hire a ton of new people. Well, I guess Facebook is paying like $1 billion for kind of top tier large language model people. But my point is that whatever the investment is going to is likely not things like materials, but more so, well, I guess data centers would be material. I mean, that's probably why NVIDIA is so hot right now. But I really, the answer is I really don't know. I think other people on kind of the micro, from micro perspectives would know a little bit better. But from a macro perspective, it doesn't matter as long as the growth continues to push higher. Thanks again, Thomas, for the shout outs and the help. Central bank still inadequate in policy and or policing the asset side. Wonder what happens when stable coins are accepted as collateral for mortgage. Oh, God help us. I don't think still inadequate in policy in the asset side. I just don't have the tools to policy to actually, they don't have policy tools to do anything really. The endogenous cycle is just so strong. Interest rates just in the grand scheme of things do so little for that cycle. Given the already high levels of private debt, how long do you see the bubble lasting? I would say at least mid-2026. Really just depends on how fast this acceleration phase lasts. So we're at about 150% private debt to GDP right now. We peaked at 175-ish, I think, in 2008. I think we can probably go higher just because of the larger fiscal, kind of foundation that we have right now. So I don't know. It took, about 2 years to increase that last 20% last time. So I say we peak in 2026 and we find out the consequences by the end of 2026, maybe into 2027. That'd be my crystal ball for now. But, and Alex, I think you are still signed up or you are a member, but we'll track it over at AppliedMMT in real time. Doug, also confused if the fiscal isn't affected by endogenous money. Are automatic stabilizers part of fiscal? Yeah, they absolutely are. Yep. And hopefully the conversation I just had made sense of that. Why I'm a little bit concerned that the automatic stabilizers actually won't hit. But yes, they absolutely are. I think the big thing is that I'm just trying to make sure that it's clear is the difference between exogenous and exogenous money, right? And that it's a policy decision to spend the fiscal side. It's not a policy decision on the credit side, and so we could end up we could end up seeing issues. We could end up seeing issues there when the automatic stabilizers kick in or kind of don't kick in. So good question. This looks interesting. Commercial real estate exposure exceeding 300%. Banks have commercial real estate. 59 of the 158 largest U.S. banks have commercial real estate exposure exceeding 300% of equity capital. Robert, that's interesting. Does follow up on that? What is like the historical? Is that grown a lot historically? Curious about that. I agree. I mean, if rates, I'd be more concerned with the Fed rates falling than macro or micro delinquencies. Yeah, I mean, if rates really start to fall, again, if rates really start to fall, the immediate impact will be lower costs on the private sector, which will kind of spur on the credit cycle. I mean, going back to this chart right here that we were looking at. Going back. Oh no, yeah, it's further down here. Going back to this chart. Let me bring my. Give me a second. Give me a second here, guys. And gals. Give me just a second here. Bring the fiscal. Bring the credit down. Part of the add to fiscal right now. So part of the fiscal add is. Part of the fiscal add is interest income. So part of what is driving this fiscal cycle higher is the $1 trillion plus of interest income. Interest rates will help this cycle, the credit cycle, in the short run, potentially, right? Going back to that and think through what we were talking about throughout this, about fiscal being the profit driver that drives the credit cycle at the macro level. If you think that through, then when rates drop, we're going to start to remove a source of profit, right? And so the interest income channel begins to deteriorate. But what you get is then an even more aggressive credit boom, especially with where we're currently at right now, right? I mean, we're already seeing credit acceleration. It's only going to accelerate more. Like if you were to drop rates, like at the end of a cycle, you know, let's say like you drop rates in 2008, you're going to get a different income, right? Because credit had already been collapsing. You're going to get a much different outcome than when credit accelerates. I mean, I think right now it's likely to be a little bit more potent for the borrowing side because the cost just will be lower. But the counter side to that is fiscal does slow. I mean, that's the thing, is that it will slow. I mean, $1 trillion less of fiscal, assuming they were to drop rates to zero overnight, sort of thing, would eventually emerge, and so you would get the counteracting headwind feedback loop from that. But you wouldn't see it immediately because the credit creation would just, you'd get an offsetting trillion in credit creation because of it, right? So, but that credit creation doesn't last forever because of the wage feedback loop that we've been talking about. All right, history time. Minsky financial instability hypothesis describes 3 phases of borrowing. Yes. Sudden, sharp market collapse. Stable coins. I like that. Hedge financing, then speculative, then Ponzi. Yes, yes, yes. What up, Zero Shot? Welcome. Thanks for jumping on. Okay. I think the last thing, I don't know, we can talk a little bit more of, again, any questions or anything like that. I'd be happy to keep going, but actually I think I will. Maybe we'll look at some tweets. I always want these streams to be me just kind of riffing on tweets and stuff, but then I feel the need to go deep into the explanation, because this is always the issue. I always come up with ideas for tweets and I'm like, God, I just need, like they need, this is going to make no sense without kind of macro theory 101. That's always, it's always kind of the concern. Dr. Sadler, you hit the nail on the head here with the dollar looking awful. That's where I'm going to go. Let's talk about the last part of this, and again, why I'm a little bit concerned here. Concerned that we're entering a bubble. And remember, in a bubble, I'm going to qualify this. Remember, in a bubble, stocks surge in a bubble because they have to. Assets have to go up in a bubble until it bursts, right? It is a necessary component that the most bullish markets look is at the end of the bubble, because it is the fact that credit is accelerating at its highest pace. More money is being created than ever. Markets push high at that point. So I am not bearish. I am saying we're in a bubble, or potentially entering a bubble. Just got to make that point clear. So speaking of the dollar, and Alex, I'm glad you brought that up. One of the issues that I think we really have to kind of fully digest here. Actually, before I do that, give me 1 second. make sure I'm not okay. The last thing that I want to think through is, and I know Warren, you guys are going to see my bookmarks. Hopefully I haven't bookmarked anything too embarrassing. I know Warren has. Yeah, okay. This is kind of important, and it all has to do with the supply shock. And I have a YouTube video as well. If you haven't watched it, and I can pull that up real quick. I know I'm switching screens here, but this video right here, the US dollar collapse, is concerning. You can see by my face how concerned I am. And it is very concerning. So I had a video where I kind of explained this in a little bit more detail, but the TLDR and the impact of it is I think what, we're living, well, I don't think, I'm positive we have a supply shock. And what's going to happen in this supply shock is the dollar is kind of collapsing, which we've seen play out. It's collapsing. The reason that it's collapsing, the video goes into this in a little bit more detail, but a reason that it could be collapsing is because the U.S. is going back to purchase power parity. What that means then is that a lot of the suppression of foreign currencies against the dollar is no longer going to happen. That'll allow the dollar to go ahead and devalue, to devalue respectively, because the desire to export to the U.S. is just no longer going to be there, because Trump has said we don't want your stuff for cheap. We want to pay more for it, because paying more for stuff means we're going to invest more. This is what neoclassical thinking gets you. Not that all neoclassicals think this way, but the issue is that in a kind of non-CPI way, but in a real way, we're just devaluing the overall value of dollars that are being created, right? So essentially, you could call it inflation. Now, I do think inflation will tick up, but it's really devaluing the real value of the new money that's being created, right? And just if you think about it, and I think I explained this, I thought it was kind of a clever explanation. So let me pull up a tab here. And was it this conversation? God, the thought experiment was, just imagine. I'll see if I can find it. It doesn't matter at this point. But if you can imagine a scenario where $1 being created in a world where only $100 exist versus $100 being created in a world where $100 exists, right? Like each of those instances are going to have two vastly different outcomes, right? Just because of what that new money can ultimately buy. And so when you get a devaluing dollar, each new dollar just buys less. It creates less economic activity. And that is where and why it's so important from the fiscal side, particularly from the fiscal side, that we look at monthly spending in terms, in real terms, right? Like inflation adjusted terms, or even though it doesn't show like dollar adjusted terms, because it's what that money can buy. And that's why like in 91 or whatever, we had that recession because we had a huge oil shock, right? And so if on a normal business cycle, you spend 5% of your income on gas, and now all of a sudden you're spending 25% of your income on gas. Obviously, that's going to have ramifications on the macroeconomy, and a lot of things that would have been profitable just are no longer profitable. And so that exact same thing is going to play out, where if let's just say your entire kind of appliance, car, essentially anything that is expensive that you're importing from the rest of the world, if those sort of things, let's just say, took up 25% of your income, but now because of the lower value of the dollar, it doesn't even necessarily have to be massive inflationary, but it's the lower value of the dollar means that's now in relative terms taking up not 25%, but it's taking up 35-45% of your weekly monthly income. That's just going to reduce profits for other sectors of the macro economy, and that is the outcome of a supply shock, right? That is, especially the supply shock that we're seeing that is causing the dollar to die off so much. And so what my concern is that even though fiscal looks very strong, is it could be weaker than it's leading on, right? And one of the explanations could very well be that we're just seeing this dollar die off here, and that is going to kind of feed back into the diminishing fiscal impact that we're seeing. So bringing it back to kind of where we're at in this zone idea, that's why again I'm more right here. I'm more right here than I am, say, right here, right? So I'm definitely saying fiscal is right, or credit's rising. It's just, what is fiscal doing? And I'm more skeptical than ever that fiscal is going to just be this massive support for so many different headwinds, and the last of kind of which here is because of this massive supply shock and what it's doing to the dollar here. And then furthermore, credit creation itself just diminishes the dollar as well, right? Like when banks create loans, that creates more dollars, and that's kind of a synthetic short on the dollar itself. The loan creator, the loan, like the person who wants the loan, is effectively shorting the dollar because they want the dollar to go lower to make their loan cheaper into the future. And then you're just also getting money creation, which pushes the value of the dollar lower as well, which again kind of exacerbates the real inflationary impact of the spending that's being created, right? So again, that's just kind of another feedback loop in this whole feedback loop. So yeah, Alex, that was, it's a great point, and really kind of the last point that I wanted to make, why again, I think we're very close. Now, qualifying here, I could easily change my mind again, depending on what the fiscal data looks like in fiscal year 26. And that's why, if you're an active trader, active investor, head on over to AppliedMMT. I mean, you get these updates every week and we can see where we're at. All right. So that's kind of the last point I wanted to make, at least with regards to that. Maybe we can go to some tweets here in just a second. Let's see. Doug is very concerned. All right. Interest rates falling. All right. Dollar looking awful. That's where we left off at. What is a good place I can learn how macroeconomic system works? I'm kind of new to all this. I would recommend your channel, Relearning Economics. That is what I would recommend. Arya, thank you so much for the information. Glad to provide it. Interest rates falling will not affect fiscal immediately either, because of all the previous issued higher rate bonds will continue to pay. Yeah, most bond issuance though is pretty short. So yeah, I mean, immediately you're correct. I wouldn't expect an immediate crash, but I think after, it only takes like a year or two for that to fully play out. Doug is very concerned. Very. I mean, it's as concerned as I've been in a while. I don't know. And I hope my politics and it's impossible, obviously, to look at anything purely objective. And I hope I'm not just seeing kind of the chaos and imparting that onto the view. And I hope I'm being as objective as possible. But I'm just seeing enough concerning lines where, where concerned is the right word. Fiscal. Okay. Yeah. Fiscal was slow. So yeah, Frank, we're in agreement. Yeah. he's throwing away the great advantage we pay for with our military adventurism. Yeah, exactly. We are undoing everything that the great late President Nixon set up for us. Tax cuts play a role as well. That decreased demand for dollar. Yeah, it's interesting. I didn't think about that. Yeah, absolutely. I thought this was a pro-Austrian economics live stream. I wanted to learn how the economy actually works. My buddy Bob Murphy can help you out. Study Ariana Grande lyrics to really understand the economy. I do like that. I'm not going to sing, but she got a couple songs that slap, as the kids say these days. What else do we got here? I'm catching up. Desire to export versus desire to import. If I remember correctly, Wayne Godley did a paper in 2006 titled something French, Increasing Debt to Income Ratio Household. Okay. I don't know if I remember that. Wayne Godley's a smart guy. All right. I think we've think we've hit the questions. So let's talk tweets for a second. I mean, actually, let's do this. Let's loop back to where we began and just kind of put a bow on the tax thing. So that's kind of where I'm at. That's why I think what we're seeing with taxes is maybe a sign that we're getting close, to that inflection transition point from a growth economy to kind of a bubble economy. And we'll see how it plays out. Negative supply shock. We kind of went over this, the impact of it. Let me just see too, if any of these are anything more than just kind of like, aren't currency treasury reserves ticking up faster than that plus endogenous money? I don't think so. I mean, I think that's kind of the argument I'm making, that we are in fact actually not going fast enough. All right, let's see. So yeah, the taxes, what else do we got? Yeah, Ben's point too about the pass through. I mean, this is really kind of fascinating and definitely worth thinking through, the pass through of how credit is finding its way into more venture intermediary type loan creation. And that's important. It's important, and that's also how bubbles continue to build, right? I mean, it's those avenues, housing, obviously, in the late 90s through the 2000s, that was a way in which more speculative type financing could end up occurring. Let's see. Bill is one I like to look at. Yeah, and this is kind of interesting too. I'll hang out here on inflation for a second. I'm in we're never going to get back to the peak that we saw in 2022, obviously, but I do think we will likely start to see inflation get a little bit hotter than expected. I would say we'll have 6 inflation prints for the remainder of the year, the July, August, September, October, November, December prints. I would say, probably the majority of those, maybe 1 or 2 won't, but my guess is we're going to start to see beats on the inflation side. What else do we got? Yeah, this is the other thing too. This will be really interesting as well. And one thing I think about quite often, which is when you're looking at and I'm not saying Bill, I use guru as kind of a pejorative term, and I'm not saying this of Bill. But what'll be interesting is you'll start to see a lot of the gurus, and you're starting to see this too. I mean, in part just because politically they feel like they have to, but you're starting to see a lot of the gurus really acknowledge that we're in this hot economy, and the economy is going to look the hottest to the gurus who follow the worst data you should be following, who aren't following the actual causal data, but kind of the lagging data. The economy is going to look the hottest when credit is accelerating the most, right? And so, again, I'm not saying this of Bill, follow Bill. He's a smart guy. The point that I'm trying to make is when you start seeing the dumbest people finally switch, like that Samantha DeLuke lady, or, I'm sorry that she comes to mind. Sorry, I'm crapping on her out of everyone, but she just comes to mind. The forest through the trees guy. I'll trash on a guy too, the forest through the trees guy as well, right? The hedge eye guy, right? When they start saying this economy, anyone on the CNBC guys, this is the hottest economy ever. It's because credit is accelerating incredibly fast, right? And knowing the laws of physics, you can't accelerate into infinity. The economy looks best right before it collapses. So I don't expect things like GDP to look low yet. I would actually expect that sort of growth to accelerate in a bubble phase. Let's see if Mark Dow has anything going good. Yeah, just pointing out fun stuff with Trump. All right. Oh yeah, my buddy Colin. He blocked me. Maybe I'm unblocked now. Yeah, I'm still blocked. Okay. He's an interesting follow. Let's see. There might be some other things. Let's look in my bookmarks worth talking about. New Fed paper showing the rise in rates. Banks reduce direct lending to firms, but increase lending to private credit creators through business development loans, I think, BDCs, business development, something. Yeah. Again, this is Ben's big point. I mean, it's a great insight. I bookmarked this one because it just ticked me off. I'm not going to give him the pleasure of responding to, but to be very clear, while I am an ardent MMTer, never ever have I ever said that only the government can create money. As I just very clearly explained, there are two engines that create money, and they have a very strong interplay with one another. Oh yeah, reserve discussion. I don't really care to get into that right now. Supply shock. Oh yeah, the NFP slow down the non-farm payrolls. Check out the most recent video that I did on that. I think that is probably the best discussion of the jobs data. I think I got it all right. Warren's still kind of concerned about the supply shock, which again I agree. Oh, this was interesting too with regards to this. Yeah, actually, this is kind of fascinating when we're trying to understand, dissect, make kind of really make something of the margin data. So if you track the margin data, and this is the FINRA margin data, you'll note that there's a very strong correlation between margin data. Again, AppliedMMT.com, we track that. We have that. It updates monthly and is important, especially when you're at near the end or beginning of cycles. But margin data tracks very closely with the credit cycle, and the point that's being made here is as a share of the total market cap, margin data has completely collapsed. And what's interesting about this is it could just be that we just have a ton of capacity for a major bubble to boom, if in fact there just is that capacity for margin data. In other words, what will inevitably happen is like we did in 2000 and 2005, we will see a big run up in margin debt. And then it'll prick the bubble sort of thing, and then we'll have a collapse. But the other explanation here, in other words, there's just massive deleveraging that's taken place, and that's the explanation for why there's this collapse. The other explanation is that it could just be a massive leveraging of using products like leveraged ETFs, right? And it's so much easier now to get kind of the portfolio construction that you want, not using margin debt, but instead using things like levered ETFs, right? Because you can pretty much get the full leverage that you would want for your entire portfolio. So I think the way to do this then, given this changing of dynamics, instead looking at things like rate of change and acceleration as opposed to actual margin debt itself. More evidence of a supply shock. And again, if you know anything about dynamic systems, actually a great thread right beneath that Ty put together. If you know anything about dynamic systems, like the bullwhip effect is such a prominent and common feature that when you do crap like this, when you shock a system like this, to the extent that it was done, the bullwhip effect will have just massive reverberations, and to a certain extent, well, I think we can do a pretty good job of forecasting it with our models. God only knows what the impact is going to be, and so I think we're close to seeing that on the back end. Another interesting thing here with regard to margin debt, and I think this is a little bit different way of tracking it, but just we're seeing once again a kind of an acceleration pickup in margin debt, which again is what our data shows. Let's see. Schiller index near highest. I know everyone was getting freaked out the other day about how overvalued markets are getting. I will talk about this next time. I'll make a note because I think I have some interesting thoughts. I like that the way I like to think about the valuation is actually to flip this equation on its head and think about it more that stocks are yielding lower than they ever have, right? And if you think about it in that aspect, then I think you can think through why they're quote unquote overvalued, and what the overvalued means at any given part of the cycle. So that is maybe where I will kind of whet your appetite for next week. So the reciprocal Shiller, yes. I'll give you a little. I guess I'll hang out here for just a second then on this thought. One reason why you could get a very overvalued, low-yielding stock market is because of a shortage of safe assets. So, I mean, you could get that as well, right? So there are ways to get that. All right, let's go back to, I think that's probably, oh, you know what? I'll answer this question too. Just again, one that I bookmarked to maybe retweet, but never did. Oh, you know what? I'm feeling a little feisty. I'm feeling a little feisty here on this one. How is this even possible? Sydney median house price relative to wages exploded over the last 45, 50 years now. How is this possible? Well, it's possible because of credit creation, right? So, I mean, Australia obviously had a 50-year long credit bubble now, and they really didn't get derailed all that much in the great financial crisis. And so, again, I mean, like we were just talking about with the credit dynamics and how the endogenous cycle plays out, if you create loans, that creates money, which creates income, which can perpetuate a cycle, and it can go on for a long time, right? I mean, if you have policy that supports it, it can go on for a long time. And so that's exactly how this happens, which is kind of an interesting thought here. And this is my Peter Griffin moment. You know, what kind of grinds my gears is this is not some like policy that is being hoisted on and forced on the private sector, right? This is the private sector deciding they want to do this, right? And there's a psychological aspect to this. And what kind of gets me going, and again, I know I try and stay off the political side of this as much as possible, but people choose to participate in the great capitalist experiment by getting a loan, right? Like, if you hate capitalism, which I don't, I mean, I think it really is the best economic engine for outcomes and that sort of thing. Don't get loans for houses because you're participating in the expansion of, you know, you essentially paying off, you know, debt for the rest of your life. That's not to give a pass to banks, but that's to say it takes two to tango. So I think in any transaction where it requires two or more entities, you have to look at all sides, and you can't just put blame on the person offering the loan. You got to look at both sides. Okay, that'll be it. That'll be it for now for things that kind of bug me. Let's move on to questions, and we can kind of wrap things up. Zaza, and again, if you do have a question, put question in your question, and that'll make sure I catch it. Why has the Canadian economy not collapsed with such a high debt to GDP? I don't follow Canada all that closely. Did they raise interest rates as much as the U.S. did during COVID? The other thing too is, I think the way that they do mortgages is a lot different than the way the U.S. does mortgages. And I think it's the same thing with Australia as well. I think, and then on top of that too, I mean, I know they only have like 5 banks or something like that up there as well. And they might be a little bit more closely tied to kind of the central bank and that sort of thing. But it's nothing that I follow too closely. Ty might have some better insights on that because he's Canadian. I like this going through tweets. Okay, thanks, Ty. Yeah, I can keep it going. I appreciate that feedback. If people like this tweet thing, we can keep it going. If the dollar's falling, which currencies would you want to hold? Ooh, that's a good question. I don't know. It's so hard. It's so hard to pick a winner here. Because like the Europeans are like, oh yeah, we're going to spend more and we're going to do it through increasing VAT tax to 400% or some crazy crap like that, right? So it's like Europe has all the chance in the world. I've never like cared to talk to a policymaker, but I'd love to chat with some European policymakers because like, God, you guys have all the chance in the world to strike here. Like the European Renaissance could finally be here, but I just don't think there's a desire for it. So what replaces it? I don't know. It's actually, Alex, it's probably a question that I should have an answer for if I'm going to say the dollar falls. I mean, yeah, the euro is probably my top pick. Could the yen? I don't know. Could the yen possibly fill that void? I have to think about it. I'll think about it. If I think about it this week and before the next stream, I'll definitely discuss that. Lorenz, yeah, man, Bitcoin, baby. What is Bitcoin doing? I don't even know where markets closed today. I know we were down like 0.5%. So let me see where we ended the day at. Down 0.75%. Let's take a look at the Bitcoin. Oh, it's my old Elliott wave count. Look at this. This Elliott wave count goes all the way back to like the last time I updated it was 2022, and look how like kind of accurate it turned out to be. I don't know, crazy. Bitcoin, yeah. I mean, we're still surging on the Bitcoin. So, okay, down a little bit. I mean, we're down a little bit, obviously, along with markets, but still holding value. Another thing that's kind of interesting too is recently we've been seeing some of those like meme stocks as well, like Krispy Kreme donut, D-Nut, and Open and stuff really take off. That's fun. Another just sign that we're probably going through some speculative fun. Okay. Well, guys and gals, I think we kind of got what we wanted to talk about today. Went through a lot. Thanks for hanging out with me, chat. If you have any questions, thoughts, that sort of thing, drop me a DM in Twitter. I'll read them. Some people's tweets keep going to my potential spam tweets, and so I noticed there were a few people that got like stuck in between a bunch of spammy tweets. So if that's you and I haven't responded, and you sent a tweet. Or you sent a DM, like I do respond to my DMs, so just let me know. It probably went to the spam, and I'm just not looking at my spam folder anymore. Other than that, that's what I've got, everybody. I greatly appreciate y'all hanging out today, and I'm not seeing any other questions come in, so I think we Blue Sky, that's the Twitter alternative. Yeah, Thomas, I'm just, as much as I don't like the owner, I appreciate the voices that are on there. So it's hard. It's the drug that I got addicted to. All right, crew. Stephanitas. Okay, I will check my DMs and see if that's in there. All right, that's all I've got. We're going to wrap things up. Thanks again for tuning in, everyone. Yeah, ketamine. Yeah, I'm addicted to ketamine. Twitter is the ketamine of social media. Yeah. Before I head out, yeah, AppliedMMT, everybody. If you're an active trader, an active investor, get subscribed. All that good stuff. If you're watching this on Twitter, you want to engage next time, make sure you hit us up over here on the YouTube stream. I will dual stream. But that's it. Have a good afternoon or evening, wherever you're at in the world, whatever part of the day it is. Yeah, enjoy the rest of your time. Till next time, good trading. Follow the flows. That's my new tagline. Follow the flows. Yeah, you'll know what's happening. All right, take care, everyone.